Keep your arms and legs inside the trade at all times. Bjorn Snyder, Jewel 11, 2026. Every July I cave and take the kids to Coney Island. Same routine every summer. A Nathan's hot dog, the Wonder Wheel to keep the peace, and then the main event. The Cyclone, a 99-year-old wooden roller coaster held together by peeling paint, nostalgia, and the collective screams of everyone in Car 3. You know the drill. The slow, clanking climb. The drop that relocates your stomach to your throat. The brief moment you question every decision that led you to this moment. Then the cars rattle back into the station and my youngest, unaware I'm now in desperate need of a chiropractor, says the only thing a kid can say, again. Welcome to the Semiconductor Trades Week. Monday was the slow clank up the first hill. The Nasdaq 100 climbed 1.7% as AI optimism returned, and Broadcom expanded its partnership with Apple. Tuesday, the floor dropped out. The chip gauge plunged 6% as the market once again asked whether all that AI capex actually justifies the multiples. Wednesday threw in an unscheduled loop-the-loop courtesy of geopolitics, with Trump signaling the Iran ceasefire may be over. Brent topped $80 and nearly 400 S&P 500 stocks fell. Then Thursday the cars came roaring back up the lift. The SOX ripped plus 5.2%, pushing its year-to-date gain to 87%. Micron jumped 8.3% after supersizing its U.S. plant spending plans to $250 billion, and the S&P rose 0.8% to 7,543.64, its best day since late June, with Meta, plus 4.7%, doing the most pulling. And Friday morning, they bolted a brand new car onto the front of the train. Semi's superstar SK Hynix made its Wall Street debut and popped 14% on insatiable AI memory demand. Down 6%, then up 5%, and everyone lines right back up. Again, thanks for reading the postmortem. If you'd like to read it regularly, then feel free to subscribe. 2 desks, 1 chart. Here's what makes this week worth more than a stomachache. 2 top brokerages on the street looked at the exact same whiplash and reached opposite conclusions. In the bear corner, BTIG's Jonathan Krinsky, whose note this week, SOX and Awe, reads like a smoke detector. The SOX has now moved 3% or more up or down 15 times in the last 30 trading days. In the index's entire history back to 1994, the only other times that happened while above the 200-day moving average were early 1999 and the first half of 2000. And into that 99 episode, semis were up a modest 35% over the prior 2.5 years. Today, 209% over 2.5 years, 162% over 18 months. Thursday's big rip actually triggered a second rarer signal. A high volatility bounce within an uptrend that has preceded 17% plus drawdowns in 95, 97, 00, 20, and 24, and showed up in June 2007, 1 month before the final pre-GFC high. The froth is already being flushed at the edges. Korea's small-cap tech complex is down 36% in 8 weeks. In the bull corner, Goldman's desk argues the sell-off has already done its job. Their momentum basket has unwound more than 20 points in a week. Hyperscaler and data center equipment valuations are back near their Liberation Day lows. Hedge fund net exposure to data center names is the lowest since early Q1, and Mag 7 positioning sits just above 3-year lows. Cheapish valuations, washed out positioning, historic earnings from Micron and Samsung setting up the season. So what's their call? Buy the dip in hyperscalers and the data center plumbing. Same chart. One desk sees March 2000. The other sees a sale rack. So far, the tape keeps siding with the sale rack, but the cyclone has been running louder than usual, and somebody should probably check the bolts. Warsh's hard yards. Away from the chip drama, the Fed quietly had a credibility problem this week. Citadel Securities macro strategist Frank Flight tracks a market-based inflation credibility factor. It's a blend of hike pricing, 30-year yields, inflation swaps, the dollar, gold, and oil. And after Chair Kevin Warsh's well-received June debut injected a premium into it, the market has now unwound nearly all of it. A close to 2 sigma retracement, with the surge in 30-year yields doing a third of the damage. Flight's framing is the line of the week. Strong words are necessary but not sufficient, and credibility is only durable once the hard yards are done. He thinks Warsh is prepared to cover those yards quickly. Translation: the hike everyone keeps whispering about is getting less hypothetical. The history here should make everyone sit up straight. BofA's Michael Hartnett points out that U.S. CPI, 4.2%, is on the verge of exceeding the unemployment rate, 4.2%, something that's happened only a handful of times in the past century. 66, 73, 90, 0, 08, and 21. Everyone was a Fed hiking year. Not one of them is remembered fondly on Wall Street. Meanwhile, the 30-year real yield just hit 2.9%, its highest since November 2008. The true cost of long-term money is back at pre-GFC levels, while equities are priced for perfection. AI American hustle now for the part of the AI story nobody puts in a scary chart. Flight's other note this week: AI American exceptionalism looks past the hyperscalers entirely and lands on Main Street. New U.S. business applications are up 24% since ChatGPT launched, with the strongest formation happening in the sectors most exposed to AI. Sequoia's data shows the median startup now raises its seed round with 4 employees instead of 5. AI is lowering the minimum efficient scale of a business, letting a founder and 3 friends do work that used to require departments. The Citadel team even finds law firms hiring software engineers and media companies hiring cyber analysts. Their conclusion in 3 words: never bet against America. And the consumer is cooperating with the thesis. BofA's card data showed the strongest consumer spending growth in more than 4 years in June, enough to send investors sniffing around consumer discretionary names again. Wall Street spent the week arguing about whether the AI trade is 1999. Main Street spent it opening LLCs and swiping the card. Follow the money. The flows say nobody's actually scared, or rather everybody's hedging their fearlessness. Equity funds took in $56.4 billion this week, the 4th largest haul of the year, led by the US and the biggest China inflow since December. Financials saw their largest inflow since January at $2.4 billion, and tech remains on pace for a record $183 billion year. And yet, at the very same time, money market fund assets just printed a fresh all-time high of $7.9 trillion. Stocks getting bought, bonds getting bought, cash getting bought. When investors are simultaneously all in and fully parked on the sidelines, at least one of those positions is wrong. And BofA's Bull and Bear indicator, pinned at an extreme bullish 9.5 sell reading, has a view on which: the tape. The headline indexes hid all the drama. The S&P 500 added plus 1.2% on the week, the Nasdaq plus 1.68%, while the Dow lagged at 0.45%. Underneath it was chaos though. Chips 6% Tuesday, SOX plus 5.2% Thursday, leaving the index up 87% year to date. Micron rose 8.3% on its $250 billion US spending plan. Meta gained 14% on the week as the S&P's top contributor. SK Hynix closed its Friday debut up 14%. Brent topped $80 mid-week on the Iran flare-up, before easing as traders trimmed risk into the weekend, with the truce described as fragile. The Mag 7, meanwhile, have gone essentially nowhere in 2026, and now trail more than 300 S&P 500 stocks year-to-date, as the selling winners, buying losers rotation into energy and laggards rolled on to start H2. The wrap. So, here's where we stand. A chip trade that can't decide whether it's 1999 or just a normal Tuesday. A Fed chair whose credibility premium is leaking and whose next move might be the first hike of his tenure. A Main Street quietly booming on AI-fueled hustle. And $7.9 trillion in cash, watching it all from the boardwalk with a Nathan's hot dog. Next week brings a CPI print with a 4 handle expected, which will tell us whether Warsh has to start running his hard yards immediately. The cyclone has been running for 99 years. Every so often they shut it down and check the bolts. My kids will be back in line next July regardless. The AI trade, that one's less certain. Bjorn Snyder, I'm a Wall Street trader at a 200 Babi asset manager. Every week I break down what just happened in markets, what drove it, and why everyone reacted the way they did. Think of it as the debrief you actually want to read, written the way I'd explain it to a friend over a beer. All thoughts are my own. Nothing here is investment advice. If this was worth your time, help it find someone else. Hit. It takes 1 second and tells the Substack algorithm this note is worth reading. Restack. It helps keep those in your network well informed. Drop a comment. I love to hear different thoughts and perspectives. Thanks for reading the postmortem. If this resonated with you, feel free to share it.